So, Module 3 is focused on the first process that we will use to execute SAP, to simulate SAP process support, which is accounting. In particular, we will first review, and every model will be structured in this way, we will first review the main concept from accounting, procurement, production, and logistics that you have to retain from other courses, and then we will analyze which are the main source of data that SAP uses to support this process, and then which are the main activities and transactions that this process use to execute activities. So the first lecture is focused on recalling or refreshing the main accounting concept that you should recall from your Accounting 211 to, let's say, effectively use SAP and execute transaction in SAP to support the financial accounting process. First of all, we are dealing with financial accounting in comparison with the so-called managerial accounting. So SAP, in reality, support two different processes. One is financial accounting, the other one is managerial accounting. In this course, we will just deal with financial accounting, and I just want to recall you the difference between the two. So, as you should remember from Accounting 211, financial accounting is everything that deal with external reporting. So, financial accounting is the process that generate financial, economic, and asset liability statement that are shared with external audience for reporting, audit, or investment purposes. So the focus is on past transaction, and the scope is the whole company. Financial accounting is everything that produce the income statement, the cash flow statement, the balance sheet, and everything that you can access, for example, from a company website, which is, let's say, opposed to the so-called management or managerial accounting, which is instead everything that relates to cost, revenues, expenses internal to the company. In particular, analyze all the expenses, all the allocation of cost, all the decision from a cost accounting perspective that are taken from the company internally. So nothing of this is shared with external people. It leads to the generation of a report, and these fall under the scope of, for example, job order costing, operation costing, activity-based costing. So everything that is finalized to calculate cost and revenue generated from executing internal processes that characterize your company. This, just to clarify the difference, so financial accounting produce something like that, so balance sheet as of 2018, and income statement as of May 2018. We also have the cash flow statement that is missing from here, which is another document that is generated by financial accounting. But that's what financial accounting process generate, compared to what managerial accounting, management accounting generate, which is, you see, something, a report like the example that you see here. In particular, here we have the job number A143. As you can see here, this is the so-called cost center, department B3, that is in charge to realize the wood and cargo crate here. And as you can see, the cost center, department B3, to realize this associated to the job A143, generate a cost of direct material 116, direct labor 88, manufacturing overhead 32, so a total cost of 236, which contributes to a unit product cost of 118. So just to remind you that management accounting doesn't realize anything that is supposed to be shared with external, but just allocate and calculate cost and revenues from an internal perspective. So these data are very confidential, are not shared with anyone, and are usually useful for decision-making purposes. Financial accounting, though, is the let's say the basis for management accounting, because as you can see written here, most of the data used in management accounting are derived from financial accounting, and the objective of management accounting is to manage and allocate costs. For the purpose of this course, we won't deal with this, but we will just deal with financial accounting, some external report generation. Just a concept that it's worth to remember is the concept of cost center. So the master data, the main data used by management accounting is the so-called cost center, which is the unit of analysis in the company that generate cost and revenues, and for which cost need to be allocated, which can be like a department, which can be individual, which can be special project. So it's a cost bucket that is used to accumulate cost and calculate cost. You see an example here. I mean, we already analyzed that. So in this case, our cost center is the department B3, which is in charge of realizing the wooden cargo crate, which will generate a future sale. This cost center has a cost allocated for the realization of this job of $236. And this will be subjected to analysis and allocation and elaboration of financial accounting. Now, reminding this definition and these two processes, let's focus on financial accounting, and in particular, what you have to recall are some principles and which are the main report generated by financial accounting. So, first of all, what is financial accounting? Financial accounting is that process that, as you can see written here, identifies data and information that the company must collect, organize, and present to shareholder and stakeholder to, let's say, respect normative duties. So basically, financial accounting is everything that summarize and communicate to the audience the monetary value of the assets that the company own, product, inventory, building, property rights, patent, whatever it's an asset that the company use. How much is the monetary value of the assets that the company own, and every economic transaction and financial transaction that the company has been subjected to in a specific period of time. So the objective of financial accounting is collect and present data about the monetary value of assets owned by a company and the economic and financial transaction that have been referred to a company a specific period of time, usually a year. In particular, whenever you think about financial account, you should think about all the numbers that you usually associate to each company: the revenues, the profit, the employee, the asset value, the number of plants. Whatever you think it's a number associated with the company is probably generated by financial accounting. Financial accounting, to be realized, follows some rules or standard. Just to remind you that the standard tell you where to register the transaction and the value of the monetary value of assets, what to register. Okay, so what is an asset, what is a liabilities, what are revenue, what are costs, and how to register this aspect. And just to remind you that in Europe the company used the so-called IFRS standard. Instead, for the United States, use the GAAP standard, again, which are slightly different, but these are two different standards that let's say have different rules in terms of where to register, so which is the format of the report, what to register, so how to classify the different item that belongs to transaction, asset, and liabilities, and also the rules to record the transaction and to record the monetary value in the financial statement. According to the GAAP standard, which are the 5 documents that the company need to produce through the financial accounting process? The balance sheet, which describes the monetary value of assets and related rights, so equity and liabilities, that belongs to the company, usually at the given point, but usually at the end of the year. Then the statement of income or income statement or profit and loss account, which instead summarize the economic value, so summarize all the economic transactions that have been recorded for a company in a given year in order to understand if the company has generated profit or a loss, which is opposed to the statement of cash flow or cash flow statement, which instead summarize the financial transaction that have been recorded for the company in a specific period of time, usually a year, cash in and cash out. Near that, we have the so-called statement of changes in shareholder equity, which summarize every operation and every transaction that have impacted the value of the equity for the shareholders. And to understand and to read all the document, usually accountant made some assumption which are summarized in the so-called notes to financial statement. Just a quick reminder that there is, when realizing the annual report and the financial statement, the GAAP use the so-called accrual basis accounting, which basically record for the year events according to the economic activity rather than the financial activity. So it doesn't matter if you have generated a revenue, a cash associated to a revenue in or out if it is a cost. Events, transaction in a company occur if the economic, let's say, event, so revenue of cost, has been has occurred for the company. So remember that for GAAP, accrual based accounting, is not the physical cash in or cash out of the money that generate transaction, it's the happening of economic activity, so revenue and cost. And in fact, the most important performance of a company, the net profit, is based on the difference between cost and revenue, which is something related to economic aspect, so not cash in or cash out. Just a quick example of what we mean by accrual basis accounting. So imagine an event, sale of a product. The sale of the product at the year 0 has an economic impact because finished goods are delivered to the customer and invoices are issued but not yet paid. So imagine that there is a difference between when I sell and when I get paid from the customer. If I sell at year 0 my product, this generates an economic event. So this is recorded as a revenue. However, in year 1, this give me back to a cash in, the customer will pay me a product. This will generate in year 1 the so-called financial event. So invoices generated will be paid by the customer. Again, under accrual basis accounting, revenues related to finished good are recognized in the net profit of the year 0, while instead no effect on the net profit is recorded in year 1, because again in year 1 you only have the cash in, which is not related to the generation of revenue. Remember, it means that under accrual basis accounting, the net profit is always different from the cash balance of the year, because revenue and cost can happen without having a correspondent cash in or cash out for the company. Listed companies, in particular, so the companies that are quoted in the stock market, are also required to provide some report In particular, what is interesting to look at is the so-called management report. So the management report is a managerial view of the company which summarizes the main economic, financial, asset and liability events of the company during the year, which are, let's say, organized in a booklet, which is usually user-friendly. If you are interested in seeing an example of this, I have put this link to the one of PAG, which is well made. So just click on that, and you will see how a management report, a managerial report, look like. Anyway. Say that, let's review a little bit how the two most important documents look like, just to be sure that we are all on the same page. So the first important document generated by the financial accounting is the so-called balance sheet. The balance sheet, as told you, describe the monetary value of assets, okay, and related rights, so asset and equity and liabilities, usually at the end of a period, which the period is usually the year. It is divided into two sections. On one side, you have assets, so the resources that the company own, which are used to generate sales, and of course, which generate also cost. And again, assets are resources that the company use, which not necessarily need to be owned by the company. Like if I'm renting, if I'm paying rent for a warehouse, the warehouse is one of my assets because I use the warehouse to stock product, produce product, or whatever you do in the warehouse, even if the ownership is not mine. So this is an asset of the company, even if it is not owned by the company, which is opposed to the so-called liabilities, which are instead the rights that other people, which means both the shareholders, so the people that own the company, and other subjects like bank, like external creditor, so rights that external actors own on my asset. So present obligation that the company is the value of the present obligation that the company needs to satisfy with two external actors, because again this actor has supported activities of the company in the past. What to include in each let's say category is not strictly identified by GAAP. So each company usually has some degree of freedom in deciding what include and how to value things in the balance sheet. But no matter what, this is usually the framework that you find. So asset is divided into non-current asset, current asset, and asset classified as held for sale and disposal group. So non-current assets are all the assets that are owned by, are all the resources that are owned that are held by the company, usually on a period of time which is higher than 12 months. So there are resources which has a life cycle higher than 12 months. Example, property, plant and equipment, goodwill, equity investment, plant, investment property, all this kind of stuff, which are opposed to current assets, which are usually assets that the company is holding and is using to support revenue and cost, but with an enterprise normal operating cycle which, let's say, expire, which is supposed to end at the end of the year, so lower than 12 months. Think about inventory. I have inventory because I usually hope to sell all the inventory or to consume all the inventory in this year. Or think about work in progress. I'm going to finish the work in progress this year, so they can become like finished product. Or trade and other receivables, so are goods that I want to like sell to other company, or they can be like credit that customer needs to pay to me, and I would expect them to pay during this year. Finally, we have the so-called asset classified as held for sales and disposal group. So basically are all the assets that comes from, for example, acquisition of company, or merge, or something, or asset that comes from disposal. So everything that cannot be included as current and non-current asset because it's not used actually to support company operation, but as further asset that comes from external company activities. The liabilities is organized in the meaning that you have on one side the shareholder equity, which is, as I told you, the rights and the property and the capital owned by the shareholders, so the people that manage and own the company. So all the issued capital that people that own the company has put in the company. And then again, you have liabilities distinguishing non-current, so that are supposed to be there like in a period longer than a year. Current liabilities, which instead are liabilities that should be exercised, that should be taken from the owner during this year, and all instead the liabilities that come from activities, assets classified as held for sale and disposal, so outside the normal operation. Again, this is how a balance sheet look like, and you see that this reflects exactly the structure that I have just explained you. So on top you have the asset distinguishing current and non-current assets, or let's say investment, intangible, and the total assets. It's in case it's 770,000. On the left, on the right, you have liabilities distinguishing current and non-current or long-term, and the equity, so the rights that let's say the shareholder of the stockholder or shareholder or stockholders of the company own respect to the company. So the amount of capital that the shareholder invested in the company. You should already know, and I will recall it like in a minute, that there is an equation in the balance sheet, which is that the total asset in any period of time always equal the total liabilities and stockholder equity. The second important document is instead the statement of income. The statement of income simply describes the economic value, so revenue and cost, that have been recorded for the company on a specific period of time, for example, the year. And again, it is drafted according to the accrual basis account. So cost and revenues, no matter if they generate cash in or cash out, are immediately recorded in the income statement at this year. Okay, and this is how an income statement look like. So it starts with the sales. Sales are being first subtracted from the operating expenses. This generates the so-called operating income, which is the first main profit that a company is interested in. So it's the profit that you use to calculate the return on investment, for example. And then you subtract or you add revenues and costs generated from activities which are not production and operation related to arrive to the final profit, which is the one that you instead use to calculate the return on equity. Again, under the GAAP, again, I don't want to be too technical, but remember that revenues are recognized when product and service are sold, which means that the risk and the rewards of the ownership, so the ownership of the product has been officially transferred to the customer or another economic subject in the supply chain, no matter if this generates a cash in. So when you transfer the ownership of a good, this is a revenue. Same for cost. So costs are recognized when the related product and service that have generated the cost have been sold, and this is form the concept of cost of goods sold. So as far as you don't sell any product, the cost associated to produce that product, cost of goods sold, are not recorded in the income statement. Or when a related resource, like for example, if you use energy, is consumed. Okay, once it's consumed, the cost is done, and and it appears in the income statement. Again, no matter if, let's say, there is an actual cash out. That's a financial event. Accrual basis accounting work only with economic event. Then, another concept that you have to remember from income statement and financial accounting, and I will explain that and I will recall that in a second, is the cost of depreciation if a tangible asset or amortization intangible asset. Because again, outside the cost, the current cost used to produce goods, service, or whatever, when company use resources, these resources are recognized as asset, and the cost of asset is allocated in the income statement according to the depreciation and amortization principle. So remember that you don't just have the cost of goods sold as the costs which are needed to produce product and service or resource that you consume to run company processes, but you have also resources like building, plant, assembly line, equipment that you use to run company processes that are recognized as asset for the company and whose cost is allocated using depreciation and amortization rule, which is the first rule that you have to remember when you think about financial accounting, and in particular financial accounting with SAP. So again, when you use an asset, when you buy an asset, for example, a plant or for example, a new assembly line, you don't allocate the whole cost to this asset in the income statement. So it's not a unique cost event that impact your income statement, but you allocate a cost which is proportional with the decrease in the which is proportional to the let's say life cycle expected for this asset. So basically you understand how much you are planning to use, how long you are planning to use the asset, and you allocate the cost proportionally to this value by decreasing the value of the asset over time. There are two methods that you should recall when you apply depreciation. One is called the straight line and the other is called the double declining balance. Let's start with the straight line with a very simple example. An asset value is $5,000. Okay, the expected life is 5 years. At the year 1, you buy an asset for $5,000. However, this cost is not immediately absorbed by the income statement, but as you are planning to use these assets for 5 years, you account in your income statement a portion of cost which is proportional to this life cycle expected. In particular, 5,000 divided 5 years is 1,000 per year, $1,000 per year. So each year you allocate a depreciation code amount which account for $1,000, and this decrease the value of the asset which year. So the book value at the start of a year is 5,000. You depreciated 1,000. 1,000 is the cost that you put in the income statement. The book value at the end of a year is 4,000. At the beginning of year 2, you have a book value of 4,000. Again, you need to depreciate the asset of another 1,000, and at the end, the book value will be 3,000. So you allocate a $1,000 cost in the income statement, and you decrease in the asset $1,000 the value of, in this case, this building that cost that building or asset or whatever it is in the example, until you reach year 5, where in year 5 the book value at the start of the year will be $1,000, and at the end of the year you will have 0. And after this, the value of the asset will be depreciated a long time, and no more cost will be allocated to the income statement. Another option is to doing the so-called double declining balance, which doesn't apply a constant sum of money every year, but it uses a percentage. So in this case, you see that you apply 40%. So every year you decrease the value of the asset of 40%. And again, of course, the account, the cost of the amortization of the depreciation allocated to the income statement every year will vary, because the book value at the end of the year and the previous year and the book value of at the beginning of each year will vary, and so 40% of the number will always be different. Like in this case is 2,000 because it's 40% of 5,000. In this case is 1,200 because it's 40% of 3,000, and so on until you arrive at the end when you will have no more depreciation to be allocated to your income statement. The second important rule that you have to remember is the so-called double entry accounting, which is something I already mentioned. So the double entry accounting, which is also called the double entry bookkeeping, is the accounting system that requires that every time you record a business transaction in your financial document, in particular in financial statement, in particular balance sheet and income statement, you have to record these at least in two accounts, because there is called a double entry, because every transaction need to be balanced. The record of one transaction need to be balanced with the same record in another account. Why? Because remember that no matter is the transaction that you are recording, every liability that is recorded must be matched with an asset item and vice versa. Remember, there is the rule that in accounting, in every instant in the time, asset equal liabilities plus the shareholder equity. So every time you touch with a transaction a debit or a credit for an asset, you need to balance this transaction by touching with a credit or a debit liability and or equities. So remember that the accounting equation was that in every period, assets equal liabilities plus equity, which means that every time you record a transaction, if you touch an account on the asset side, you have to balance this transaction by touching also an account on the liabilities or equity side. And I have an example here just to show you. So imagine that you suppose you purchase out of the pocket a new desk that cost you $1,500 for your office. Okay, so the transaction has two parts. So you spend an asset, so you are taking out of the pocket cash $1,500, and you are buying an asset. So your asset is increased in furniture of $1,500. So, from respecting the double entry accounting principle, you must modify two accounts in your company book. So the cash account to record the fact that you have less $1,500. So you credit the cash account, and you debit the furniture account, which instead increased of the new value. The asset value does not change. You see, you decrease one cash and you increase the other. Suppose instead that you want to purchase $5,000 worth of widget of credit. This means that you have new inventory assets, but you are actually not paying out of the pocket this investment, but you are adding this to your accounts payable account. So it means that on one side you have a debit because you are increasing your inventory, okay? Because you are increasing of $5,000 purchase for this new line of credit. On the other, you have to to give back this line of credit at a certain point in the future, which can be this year or the next year, which means that an account in the liabilities, accounts payable, will be credited of the same amount. In this case, asset equal liabilities, because you are increasing inventory of $5,000 of debit, and you are increasing also accounts payable of $5,000 of credit. Asset equal liabilities, and the double entry accounting principle and the accounting equation is respected.